All right, let's jump right in. There's this one trading rule that almost everyone's heard of, and honestly, it sounds like it makes perfect sense. The idea is if Friday's high is lower than Thursday's high, well, the market's showing weakness, so Monday has to fall, right? It just feels logical. But today, we're going to flip that entire idea on its head. I mean, you've been there, haven't you? You're staring at a chart, you see that weakness so clearly, the market just fails to push higher. And you think, okay, this has to drop. There's no other way it can go. It's an instinct so many of us have. But what if that instinct is actually setting us up for a fall? So, this is the core belief, right? When market becomes weak, it must later go down and touch old lows. It's a simple little rule. It's something you can see on the charts, and hey, when it works, it feels like you've discovered some kind of secret code. But there's a huge flaw in this thinking. And that brings us right here. We're going to really unpack why this super logical sounding observation is in fact a massive trading mistake. The thing is, you're not wrong for seeing it, but the conclusion you're drawing from it, that's where things go sideways. This right here is the whole game. We treat these market patterns like they're promises, like the market owes us something, an absolute guarantee. But you know what? The market doesn't make promises. It's just a giant auction, and auctions are all about probability. The market might go down, or it might not. Let's make this super simple. Think about a vegetable market. A guy is trying to sell tomatoes for 50 rupees on Thursday. Friday comes and nobody's buying at that price, so the price stays lower. That's weakness, for sure. So what happens on Monday? Well, maybe the sellers panic and drop the price. Or maybe a big restaurant suddenly needs tons of tomatoes and the price shoots up. Or, hey, maybe there's some news about a tomato shortage and the price gap's way up at the open. You see, all three are totally possible. Weakness today doesn't promise a direction for tomorrow. So why does the market seem to break its promises all the time? Let's get into the psychology of it. Why our brains are so eager to create these rules and why the market just doesn't care. This is where we learn to separate what we see from what we assume. And a lot of the time, this guy is the culprit, confirmation bias. Our brains are basically pattern matching machines. They love finding rules. So when you see this setup work out a couple of times, your brain goes, aha, I've cracked the code, this is it. But what about all the times it failed? Well, your brain just kind of sweeps those under the rug, calls them flukes. Because our brains hate randomness, they'll invent a flawed rule just to feel like they're in control. And here it is. This is the big aha moment. Your observation isn't wrong. You really are seeing something important. When you see the market fail to make new highs, you're watching pressure build up, like coiling a spring. Your mistake wasn't in seeing the pressure. The mistake was assuming that spring could only uncoil in one direction, down. Okay, so let's take that idea and turn it into something we can actually use. We're going to stop trying to be fortune tellers. We're going to stop predicting direction. Instead, we're going to start trading the real signal we've been seeing this whole time, pure market pressure. So, if that old rule is broken, what's the new rule? What's the real rule? Get ready, because this can literally change the way you look at a chart forever. It has nothing to do with predicting where the market is going to go. Here's the new rule. It's not the market must go down, it's the market will soon move strongly. That weakness you saw, it wasn't a directional arrow pointing down, it was a giant warning sign. It was the market screaming, hey, get ready, a big move is coming. Which way? Who knows? And the beautiful part is, we don't have to. All right, this is where it gets fun. Time to turn all this theory into an actual practical strategy. Now that we get it, we're trading the release of pressure, not a direction. How do we do it? Well, welcome to the pressure breakout setup. We're going to break this down into 5 dead simple mechanical steps. How to spot the pressure, how to sit on your hands and be patient, the exact moment to get in, and then how to manage the whole thing. No guesswork, no gut feelings, just a rock-solid plan. Okay, step 1, find that pressure. And guess what? You already know how to do this. You're looking for those exact same conditions on a daily chart, a Friday high that's lower than Thursday's. Or maybe it's just a few small candles all bunched up in a tight little range. All you do is mark the highest high of that range and the lowest low. And that's it. Boom. You've just drawn your pressure box. Now, let's jump to the single most important rule in this entire playbook, the entry. This is everything. You do not, I repeat, do not enter a trade until a candle closes completely outside your box. Not a little poke, not a wick, a full body close. And let's be absolutely crystal clear on this. A price just barely touching the line and then pulling back? Nope, not a signal. A long wick that stabs outside for a second? That is not a signal either. Those are traps designed to fool you. This is what we need to see. This right here, a full candle body. The whole thing that forms and closes completely outside of that box we drew. It doesn't matter if it's a 5-minute or a 15-minute candle. When you see that, that's the pressure cooker finally blowing its lid. That is our signal. It's go time. If it closes above, we buy. If it closes below, we sell. Simple as that. Look, having a great entry signal is only half the battle. The other half, and this is the part that decides if you actually make it in this game, is having unbreakable rules for your MUN and your mindset. So let's talk about the rules that will keep you alive. This right here is the foundation of everything. Your risk on any single trade has to be so small that you feel absolutely nothing. If you're in a trade and your heart is pounding, you're trading too big, period. Good trading should be boring. We want the outcome of any one trade to be totally irrelevant. And here's what that actually looks like. A good rule of thumb is to risk about 1% of your account per trade. So if you've got a 50,000 rupee account, the absolute most you can lose on a single trade is 500 rupees, no more. This isn't about hitting home runs. This is about staying in the game long enough for your strategy to work its magic over time. And let's talk about the pro mindset for a second. Pros are patient. They might only take 1 or 2 trades a day. Beginners are clicking buttons 10 times a day, chasing every little wiggle. Pros kill a bad trade instantly, no questions asked. Beginners pray for it to come back. You have to literally do the opposite of what your instincts are screaming. Cut your losers fast and let your winners run. I just love this. It sums up the entire philosophy perfectly. When market is silent, prepare. When market shouts, trade. The quiet, boring, sideways market, that's when you do your homework. That's when you draw your boxes. The loud, explosive breakout, that is the only time you actually do something. So I'll just leave you with this one question to chew on. Take an honest look at your trading. Are you still in the prediction business? Still trying to guess what the market must do next? Or are you ready to make that shift? To become a trader of pressure, waiting patiently for the market to reveal its hand before you place your bet? Because really, that difference is everything.